Hi, my name is James and welcome back. Today we're going to discuss Australia, the key issues it's facing, and go through some solutions that I can think of, and some things we can't fix. Okay, so the things we're going to discuss are the economic outlook, housing supply paradox, international trade in China, exchange rate and capital flows, political characteristics, and then finally conclude. So the economic outlook. So we can see since 2020, there's been a key structural shift in labour productivity. It's been going down, but GDP's still been going up. This is mainly due to migration. And as you can see historically, they both largely grew in line with each other, but since 2020, there's been a structural change, and that's what we're going to explore in this video. So before we can look at all that, let's look at the debt GDP ratios and see where debt and credit creation is coming from. So we can see in the 1990s, a huge run-up in credit or housing debt. This is caused by mainly the introduction of negative gearing, or the reintroduction of negative gearing, basically the capital gains tax deductions and the huge property tax incentives to buy property. So everyone started piling to real estate and also interest rate cuts. And eventually this led to a 2008 financial crisis in the US, which then had an impact on Australia. And basically the government took over credit creation and started driving the economy. You can see here 2008 is Australian budget deficits. You can see after 2008, the Australian government took over. So you can see the massive interest rate cuts fueling a huge property bubble. This is why you can see here in the late 1990s, interest rates coming down, inflaming, plus all the government tax subsidies basically drove huge investment into real estate, and then the Australian government basically taking over. The problem is a sharp rise in interest rates with a huge amount of debt to GDP is not a good look. Okay, so we can see here that household consumption is a massive driver of Australian GDP. And if houses start falling, the wealth effect, and then people cut back on their spending, this could be massive for Australian economy. But I want to draw your attention to is the ever-larging growing share of government consumption, which is that government spending we spoke about back here, and also their gross capital formation falling. We can see here that back in the 1960s, there was about 33% of GDP, and it's fallen to about 27%. And it's not just this, it's the actual net investment. So after you have existing capital, which basically depreciates, like your buildings, your infrastructure that produces stuff, and over time, basically you need to repair this. So the problem is basically that this repair has been constant, but Australia has not been investing in its infrastructure. You can see here the investment rate or net investment rate back in the 1960s was around 14% of GDP, and now it's all the way down to about the 1991 recession levels, very low, around 6%, which is chronically. You can see Australia's mining boom between 2000 to 2012 briefly offset this, but it's been a long-term structural downward trend in investment in Australia, essentially. So, and we can see here after the housing basically, after the introduction of negative gearing, lower interest rates, we can see everyone start pouring into real estate, start borrowing against the houses to spend. This led to a consumption boom and this huge, you can see here, the huge productivity boom. It's more of an artificial productivity boom because caused by credit expansion, which is not sustainable, but eventually after 2008, they started paying down, or mortgage holders started paying down their mortgages rather than borrowing against their house. And this led to huge savings into Australia. And what happened was the Australian government to take over, because if you think about GDP, you have one side coming from your domestic or private, and then one side from your public. So if your public or your private starting to pull back, like you see here, they're starting to save more, or you need a government to spend more to basically keep the same amount of GDP. Okay, so where's all of Australia's savings? Like, if they're not, why is this structural downward trend happening if Australia actually has a shit ton of savings and superannuation? The problem is a lot of this savings is locked up to retirement, so it can't be used, and a lot of it's invested overseas. So you can see here in 2013, only 35% of our superannuation, or actually it's a bit less than that actually, was invested overseas, and now it's almost up to half. So you think about this, if you're not investing in Australia, you're basically going to have some long-term structural issues. You're not going to have productivity gains, and over time your incomes and wages are going to stagnate. And you can see a lot of the superannuation investments actually going into property rather than Australian domestic shares, and equities overseas being what's been bought up, so the S&P 500. And Australia's fertility rates collapsing, with underinvestment, the rise of the independent woman, and a lot of left-leaning policies. We're having a structural decline, and this will be a problem in 20 years when we don't have enough workers, and also all the women start to retire. It's like a two-tier effect. So we can look at our GDP per capita versus GDP. You can see prior to 2006 or 2004 that they both grew in line with each other. So this means that the average Australian was getting better off, their incomes were growing, they had basically a greater share of GDP, and they were getting better and better lives. But after 2006 or 2005-ish, after the John Howard migration policies, you can see a huge uptick in migration. This basically led to this huge, well, let's use better words, enormous difference between the GDP growth, quarterly GDP growth, and GDP per capita. So this basically means that even though the GDP is going up, it's being driven by migration, and the wealth for the average person is actually starting to decline. As you can see here, it's actually turned negative in 2024, and the average person actually went backwards. So the housing supply paradox. So why are house prices skyrocketing, but main construction relatively stable? So it doesn't make sense. If you think about it, if house prices are skyrocketing, wouldn't everyone just start building houses and make a ton of money? So you can see here, after the 2000s, it's actually been a chronic underinvestment, or like below what you would expect for gross capital formation. So it's like investment in housing and building new and new housing. It's basically been below what you would expect. And this is because of monthly dwelling units being very hard to get. Like this thing called NIMBYs in Australia, where people say, let's build a lot of houses, but then the local council has so much power that they say, just not in my area. And then houses don't get built. So you can see here, even though house prices have skyrocketed, we've had relatively flat unit approvals or dwelling approvals. And some other key structural shifts that I want to talk about is that even though manufacturing's left Australia like a shit ton, the mining as a share of GDP has basically offset this. And the problem is that this mining is very reliant on China. And that's what we're going to talk about now. So we can look at Australia's basically trade openness. We can see that in the 1980s, Australia was actually a very closed economy. They didn't like to trade much. But after the Paul Keating era, we had a huge transfer with the Australian dollar floated, and then opening up our current country to capital flows. And this led to huge investment in our mining. As you can see here, all these, it's not a great chart. All right, so you can see that what Australia exports is mainly iron ore, your rare earths, your minerals and fuels, like our oil. We actually export quite a bit of oil. And we can look at this as well. So the rise of China as our export. So we basically export all our iron ore, gold to China, and that we've become very reliant on them. You see about 35% of our exports, or good exports, are going to China. And we look at here as well. When you deindustrialize, lose all your manufacturing, what happens now is you have to import all your machinery and transport equipment. And this makes it very problematic, because if you have low investment, it's very expensive to import equipment and machinery, and then basically it's also incentivized you to basically deindustrialize further because you become reliant on imports. We can see here China basically skyrocketing as our number one importer as well. It's like a bilateral trade. So total imports from China, this is also another problem, because we can see how Australia's economy became very reliant on China as it boomed. But the problem is China's economy is stalling. So their imports from Australia, if you look at imports from 2021, 2022, they're actually flat. And for Australia, they're actually going down. So if imports are going down and our mining's very reliant on China, well, you can expect a reduction in mining exports. And we can see here the Australian service exports for China is very high as well, around 15%. And if we look at travel, it's the number one of our exports as well. A service export is basically from our education. We basically rip off foreigners that come here, get a university education that's pretty much worthless, pay hundreds of thousands of dollars for it, and that's how we make our money. So we get look at here as well for Australian service imports from actually the US. So we import a lot of our tech services. That's all the S&P 500 companies, your Facebook, Instagram, all those kind of products, and travel as well. Tourism's basically a massive import that Australia gives to the world because we go out and travel a lot. So exchange rate and capital flows. So the Australian dollar is pretty vulnerable to global shocks because we rely on basically financial investors to invest in Australia. If financial conditions basically seize up, we run a huge financial account deficit, so we need those capital flows coming in. If they suddenly dry up like they did in 2008, the Australian dollar falls off a cliff. And you can see how here we actually have a huge primary income deficit, which is driven by the fact that we pay a ton of dividends, a ton of interest payments abroad because our mining companies are all owned by America and China. And this leads to huge capital flows leaving Australia. And we need to become very reliant on financial account inflows, which is why our interest burden is getting so big. So political characteristics. We have federal parliamentary democracy and a constitutional monarchy, which makes it kind of hard to make any changes because we got to go through a democracy and it takes a long time. The China exposure is quite big, and the AUKUS deal is obviously a problem because we rely on America for our security, but our bilateral trade partner is China, or our largest one. And the biggest thing I want to leave you with is the fact that if we just cut off this, so instead of allocating to international investors our superannuation, started investing in Australia, like cut this down to say 20%, capped it, say Australian government capped it, it would lead to, and then created also the conditions to invest. So you basically, what you do is create subsidies, or instead of subsidies, maybe no tax on these investments, and then superannuation could pull their savings, or Australia's savings, into infrastructure projects, say for energy, and basically create this productivity environment that can fix this long run detachment. Because if you're just building on migration and then you get Paul Hansen in and then she cuts down migration, well, you got migration collapsing, housing collapsing, and China collapsing all at once, and you can have some very big issues.